So in the eventuality that, because it's going to be a tough call, the central bank has to, the meeting starts today, so the central bank has to decide, which best would suit the economy, where everybody will be in a win-win situation. So if we have a 1% on shareholders' funds, for instance, now, then definitely we can have a win situation.
I believe so. I believe so. I don't think the problem we had with the demand for FX was because the open position limit was too wide at 1%. I think we had to contend with other issues that has to do with managing the FX demand and supply. But if you reduce the open position limit and deny the market of liquidity, then you further constrain the market from attracting foreign portfolio investors into the market, into Nigeria.
So, but what happens, sorry to cut you there, but what happens if we see oil prices drop further from where they are today?
If we see oil prices drop further from where we are today, there are several things the government can do. One of which is to draw down further on the foreign reserve. Second factor is to borrow. We've seen Ghana borrow. We've seen Ghana approach the IMF and World Bank to borrow. There's certainly nothing wrong with borrowing. It's unfortunate that we did not have the reserve to cushion the drop in oil price, but it has happened on us. So if we have to borrow to stabilize the economy, we need to borrow. The good thing about oil price is this. The current downward trend we're seeing in oil price will not subsist. And it's very simple. If you look at the recount today, you see that the recount is declining. If you look at the investment in exploration and production, you see the major companies Shell is sharing with Mobil is shutting down on some of their planned investments. So you're going to see production decline because additional wells are not coming to the market, and those marginal fields that are expensive to produce are shutting in. Eventually, I believe, I'm convinced that before the end of the second quarter of this year, you will see oil price trend northward because production is declining, and at least demand has remained stable.
Yeah, but then all those other variables, including the fact that the U.S. seems to still have stepped up its own production output, hasn't changed astronomically.
Yeah, but that's why I did mention to you. Go and look at the recount. The fastest decline we are seeing in recount is happening in the U.S. Because those shale gas, those shale oil formations are expensive to produce. At current crude prices, the marginal cost of extracting crude from those shale formations is now, in most instances, higher than the pump price, the crude price. So for every liter or every barrel of crude that is extracted from an expensive field, you are going to be incurring a direct cost, negative margin from extracting it, selling at current price. So automatically, that's a major incentive to produce. So those who have such wells are beginning to shut in those wells, which is also part of the plan or part of the strategy that the OPEC adopted, that they will allow price to drop to the level that marginal productions will be shut in, will withdraw from the market, and then market will stabilize on its own.
Well, let's take a quick break, catch our breath, and we'll come back and continue the conversation. When we come back, we'll be looking at the possible ways that the CBN's MPC should think about, in terms of staying on this index in the coming months. You're watching Business Morning on Channels Television. The conversation on the program has been on the state of the economy, with particular emphasis on recent development with regards to the bond market. I've been having a conversation with the Managing Director, Chief Executive Officer of Kari Assets Management Limited, Mr. Johnson Chukwu. Mr. Chukwu will be here with me in the studio when I return in just a moment. Please join us again. Welcome back. You're watching Business Morning on Channels Television. We'll continue our conversation on the state of the economy, particular emphasis on Nigeria's foreign exchange market and, of course, the bond market. I've been having a conversation with the Managing Director, Carry Assets Management Limited, Mr. Johnson Chukwu. Mr. Chukwu is still here with me in the studio. Thank you so much for sticking around.
My pleasure.
So we've talked about the situation, we've looked at the challenges, and we've looked at the issues. Now let's look at suggestions. It's a critical meeting that the MPC will be having today. It's the first for the year, and it's going to really determine how the economy, rolls, at least for the first quarter or first 2 quarters of the year. I know that one of the suggestions you already made was that the percentage for open banks position limit should be moved by another 500 basis points, or?
No, actually, to move, we are at 10 basis points. We should move it to, we are 100 basis points. We should move it by 900 basis points.
By another 900 basis points.
Back to 1%.
1%.
Of shareholders' funds.
Well, what if the committee decides to take the option of even moving it higher to 1.5%?
No, if you move it higher, there are 2 things you risk. One, you risk encouraging the banks to speculate, basically speculate on FX.
Which is what the central bank is trying to curb.
Which the central bank wants to avoid. But beyond the issue of speculating, it also exposes the banks a higher risk. Because basically, the open position limit is the maximum amount of foreign currency they can carry. Currencies could move in either direction. Where you are carrying a huge position that is not squared out, and currencies move against you, you could take a huge loss. And that's why it's indexed to shareholders' funds, to kind of indicate the maximum that the shareholders fund can absorb, loss the shareholders fund can absorb. I think 1%, given the current situation, is relatively okay. But beyond the issue of open position limit, the federal government, Ministry of Finance, or the central bank, the federal government can also enter into an agreement with any of the multilateral lending agencies for a standing facility to assure foreign portfolio investors and other investors in the country that the country is willing to draw on that line to stabilize the currency. You see, the problem is always that your currency must be at a fixed rate. The problem you have is if the currency is moving in a zigzag format. But
right now, because of this same challenges that the market seems to be having and to curb speculative trading, we know that CBN in November actually devalued the Naira to 168. And the CBN governor says that in spite of what JP Morgan is saying, the Naira is correctly valued at 168 Naira band.
I think on that area, I don't think the JP Morgan has an issue with the devaluation to 168. The JP Morgan wasn't talking about the valuation of the Naira. JP Morgan was saying that your interbank currency, interbank FX market lack liquidity, and therefore your bond market lack liquidity. Remember, this is local currency bond instrument, which means for any foreign portfolio investors to invest in it, must convert to your local currency. So if they cannot buy your local currency or sell your local currency easily, that bond will lack liquidity, and that's basically what you have to recognize. JP Morgan is not holding on to whatever is your exchange rate. JP Morgan is saying that, look, irrespective of whatever your exchange rate is, those who want to convert their currency, foreign currency, to your local currency, must have people who are ready to buy from them. And those who want to convert your currency to foreign currency should have people who are ready to sell the currency to them. They cannot depend on central bank because they cannot buy from central bank. Central bank already said, like, look, all money market, all investment instruments must be sourced from the interbank market. So if the interbank market does not have liquidity, then those who are sourcing funds from that market will not have liquidity in the instrument. And that's the crux of the matter. Okay, so
let's go back to that point you were trying to make about the standing facility where the federal government should talk to all these international financial organizations.
Yes, I think at $34 billion, we are not too low. The reserve is not too low. I believe if oil price that I saw today, Bloomberg said oil price has moved back to $50, Brent. And I've always said this, that if you see rig count declining, if you are seeing investment in new exploration and production declining, you are exactly going to see a reversal of declining oil prices. Having said that, what I think at $34 billion, we are not too low. But the government can also enter into an agreement with a loan agreement with any of the multilateral agencies, IMF, World Bank, for maybe $10 billion, whatever amount they think they are comfortable with. That can only be drawn if certain things triggers, under certain triggers. Probably reserve drops to 20 billion, you draw on that. But that gives those who are investing in Nigerian instrument the assurance that this country is willing to provide liquidity to their instrument whenever they want to exit. The challenge with foreign investing in, one of the key risks of investing in a foreign currency local instrument is exchange rate risk. Those exchange rates come in two formats. One, that the country could impose exchange controls, fiscal exchange control that says you can't take out your money. Two, that the currency could be devalued. If the currency is devalued, you suffer exchange rate loss. If the currency does not have liquidity, you are trapped. You cannot even recover any of your investment. And that is why for JP Morgan, liquidity is very critical in a currency, in any instrument being included in this global bond index.
So we have the suggestion of moving the percentage of banks' open position limit from 0.1 to 1%, and then the suggestion, of course, of standing facility with international.
Yes, if just an assurance, kind of assurance, which you draw if it becomes imperative. At today's reserve, I don't think we may need to draw it, but it gives, it's a kind of a contingency plan in case things do not go well.
So aside from these two suggestions, is there any other thing that the monetary and the fiscal authority should be looking at, doing right now to ensure that this assessment, because it's going to impact very negatively on the economic status of Nigeria if for any reason Nigeria has to be removed from this index. So your last words going forward, what else should we be doing to ensure, what else should the country, the fiscal and monetary management team be doing to ensure that Nigeria remains on JP Morgan's GBIEM index?
Well, I think basically one decision maker should always recognize that, look, Nigeria is highly integrated. The Nigerian economy is gradually getting highly integrated into global economic space. Decisions that you think are local have global repercussions. So whatever decision we're going to take as it relates to monetary policies or fiscal policies, we should also recognize how it reverberates in the global economic space. And that is why a country like Russia has failed to impose any exchange controls despite the fall of the ruble. So you cannot impose exchange controls in a format, though you do not call it exchange control, but if you take out open position limit, you deny your instruments liquidity. And if you allow liquidity, your economy cannot be attractive to foreign portfolio investors. We must, at all times, assure foreign portfolio investors we're ready to run a free market economy and allow for free entry and free exit of anybody who wants to invest in this country.
Well, thank you so much, Mr. Shuku, for joining us on the program and sharing your thoughts with us. It's been an interesting conversation. Of course, if you know you missed out on this conversation, you can watch the edition of the program on youtube.com/channelsweb /videos. Well, thank you, Mr. Chuku, for coming on the program this morning. And we've been looking at the state of the economy and, of course, with particular emphasis on JP Morgan Chase assessing of Nigeria's suitability to remain in a key emerging currency bond index it manages because claims of a lack of liquidity in Nigeria's foreign exchange and bond markets. Of course, the central bank has dismissed this. And also we're joined via Skype from Davos Cluster, Switzerland, the venue of the 45th annual meeting of the World Economic Forum, by Elsie Kanza. She's the director head of Africa at the World Economic Forum. Of course, that's the program for today. Thank you so much for being a part of it. I'm Harriet Tagbinyi. Bye-bye.